Hello, everyone. This is Rick Hopkins, best-selling author and president of RH Consulting. Now, tonight's training comes from step 2 of my 3 steps to financial success process. Turn everyday expenses into write-offs and lucrative tax deductions. Now, the cost of parenthood is something we don't often think about, or maybe we think about it all the time. But how much do you spend on your kids each year? For every $100 you spend on allowance, clothes, cell phones, electronics, movies, toys, etc., you must earn around $130 thanks to income taxes. But what if it only cost you $100? And what if that same $100 was also tax deductible? Now, we love our children, and they're worth every penny that we spend on them. But why spend after-tax dollars when you don't have to? Now, this strategy requires a strategic business venture. Now, we've covered the SBV in previous training, so I'm not going to go into that again in detail here. But instead of giving them an allowance, pay them a salary of up to $6,300 per child per year, and it's all tax deductible. Okay, in order to claim this deduction, there are certain rules you must follow. 1, you must have an EIN number. 2, you'll need a business name and classification. 3, a business bank account. 4, an employee bank account. 5, a contract signed by both parties. Now, you must pay a reasonable wage. In other words, if your child is 6 or 7 years old, it's probably not reasonable to pay them $20 an hour. I mean, what could they possibly do that was worth that? But if your child is older, 16, 17, 18, let's say they have pretty good computer skills, internet skills, they have something that is marketable, then you can justify paying them a slightly higher salary. Now, what's an EIN number? An EIN number is to a business what a Social Security number is to an individual. Now, it's free. You can get it online in 15 minutes. Just go to www.irs.gov. Now, you'll need an EIN in order to set up a business bank account. Now, business bank account also allows you to keep your business income and expenses separate from the rest of your finances, and that comes in very handy at tax time. Now, let me go over the basic business classifications. 1 is the sole proprietor. Now, that's where you and your business are one and the same. Business and personal assets and liabilities are shared. Now, partnership. It's similar to a sole proprietor where the partners share equally in the business's assets and liabilities. Now, a limited liability corporation, better known as an LLC, offers some separation between personal and business assets. The need for an LLC increases with risk. Now, corporation, it is an entirely different ballgame. It establishes a completely separate, fully liable legal entity. And that's beyond the scope of the SBV, the home-based business that we're going to be working from, probably will not need the protection of a corporation. An LLC is probably the most you'll need, but that really depends on really how big your business gets and how profitable it becomes. Okay, you must have a business bank account from which to generate salary payments and a personal bank account to receive salary distributions. Use your business account only for business. Now, this makes record keeping and tax filing much easier. Also, set up recurring entries in your cash flow manager as backup documentation. Now, again, the cash flow manager is something we've covered before in a separate training. That's your software that tracks your income and expenses and makes filing your taxes easier. Now, your child must have a personal bank account from which to receive your salary distributions. In other words, when you pay them, money's got to go somewhere so that he can take the money out. He or she can take the money out. Okay. This can be a little tricky for very young children, especially with checking accounts. Passbook savings accounts are an option for younger kids who are just too young to write checks. Now, the child must sign the check or the withdrawal slip. In other words, you can't set up a personal account for your child and you be the one that puts the money in and takes the money out. That's just not good business. Now, the contract is very important. Now, to the left, you'll see the requirements that every simple contract must have. Now, the job duties must be clear, explained, and agreed upon by both parties. The responsibility is the same, compensation the same, and accountability. Everything needs to be clear, understood by both parties, agreed upon, and signed off on. Now, the key to dealing with the IRS is documentation, documentation, documentation. If you can't document it, you can't prove it, you can't claim it. Now, a contract signed by both parties is required. And again, be reasonable when setting compensation, hours, and job duties. Now, this strategy allows you to convert after-tax dollars spent on your children into tax-free disbursements that serve to lower your taxable income. Now, by making less of the money you already make taxable, you put more money in your pocket to pay bills, lower debt, and invest. So, the Hire Your Kids strategy is a must for anyone with children, and it's one of the least known and least utilized strategies that can put major dollars back in your pocket. So, if you have kids, I take a look at this strategy. This is Rick Hopkins, and I wish you the best in financial success.